Hello, everyone. My name is Eugene, and welcome to Finance Talk. Today, we will speak about probably one of the most important rules for investors. It is used by top investors like Warren Buffett, Charlie Munger, Manish Pabrai, and others, and it literally can save you thousands or even millions of dollars. Yes, I'm talking about margin of safety. Today, we will understand its concept, how it works, and how you can implement its principles to your investment decisions. Stay tuned. But before we start, I would recommend you to subscribe to this channel for more videos and hit the like button for great confetti. Thank you for doing that, and let's start. First of all, let's understand what the margin of safety is and how it works. I will give you the simple example so you can understand the logic. Suppose we have two friends, Peter and John, and they both want to buy houses in the local neighborhood. Every one of them has $150,000 for their future perfect home. Peter is kind of hasty guy, and he prefers making fast decisions without spending a lot of time on thinking. And in this case, he does this as well. He goes on the local websites, finds several options, makes some calls, and eventually buys the house at $150,000, a slightly above market average of $120,000 in this neighborhood. His logic is that he can do some renovation in this house. He has a good job, the market is quite stable, and if he needs, he always can sell his house for a larger price which he bought it. John, on the other hand, spent more time on his decision, analyzing information about the market, about the owners of these houses. Eventually, he found the great bargain, which is below the market, and he spends only $100,000 for his house. In 1 year, due to unexpected situation, both of them need to sell their houses. In this case, the situation on the market changed. Instead of $120,000, the price dropped to $110,000 as the market average. So for Peter, it is complete disaster. He understands that he can lose a lot of money. He didn't do any renovation at all, and he actually can lose money if he sells his house for less money than he bought it. But using his abilities and negotiation skills, he eventually made the deal and sold his house for $120,000, declaring $30,000 loss on this buy. John, on the other hand, also made some work, but his situation is not so crucial. He made some negotiations as well and sold his house for $115,000, actually collected some profit on his initial buy. And this is the simple explanation of how the margin of safety works. You buy the particular assets at a cheaper price, protecting yourself from the downside of the market. And then if you would like to sell your position, you would not lose so much, or you will actually earn some money. This concept can be applied not only in the real estate, but in the investing in stock market, private businesses as well. This concept is also used by modern top investors like Manish Pabrai, Warren Buffett, Charlie Munger, Li Lu, and others. They usually have different opinion on at what price you need to buy the particular asset based on the projection of revenues for any particular company and a risk tolerance of the investor. Manish Pabrai, for example, told in one of his interviews that in the beginning of his investment career, he looked for bargains and bought $1 bills for 30 cents. So we can consider that 30 to 50% margin of safety is quite enough to protect you from the downside. Of course, it is not the only one indicator, and you also need to understand the business, its competitors, the industry, etc. Speaking about stock prices, we just go and look for the true value of the company and compare it with the market capitalization. And if the intrinsic value of the company exceeds the market capitalization, it is a great way to start your analysis and maybe buy this stock in the future. Now, you maybe have a reasonable question. Okay, this is an important concept. How can I understand the true value of the company? Because the market is efficient and all the prices already reflect the true value of the company. There are a lot of analysts who carefully watch the news and make professional decisions on when buy or sell their stock. And in some cases, you would be probably right. But as you remember, the stock market is auction-driven thing, and we as investors need to look for bargains or anomalies. Personally, I think that there are several situations when the intrinsic value of the company can exceed the market cap. And I divide these situations into two big groups. First type of occasions is also called special situations. This can be positive or negative news about the company, its competitors, local or international laws which can affect the company, maybe some external factors like earthquakes, wars, etc. The great example here is the company which is called EPAM. It provides IT services and consulting for companies in the United States, and some of the workers are situated in the Ukraine. But due to the conflict, the company's stock was really affected. Another great examples can be retail companies. Your prices for the product can be really affected by the import tariffs, cost of goods for materials or other resources, or transportation tariffs. All of this can affect your product prices, which can lead to increase or decrease of net profit, which eventually will affect the stock price. Official reports are also part of these special situations. For example, several months ago, Meta Platforms announced decreasing of one of its metrics while others increased, and eventually the stock price dropped approximately 30%. Well, I do not say that you need to go and buy all of these stocks which I mentioned above, but it is a quite great way to start for your analysis and understanding why it actually happened. The second big group are situations which occur when the market doesn't clearly understand the true value of the company. They can occur when the company has some underlying assets which are not mentioned in its balance sheet. The great example here is the story from Manish Pabrai in one of his latest interview when he bought Silicon Valley Bank in 1990s due to dot-com bubble. Silicon Valley Bank had a very interesting business model. The bank gave the credit to small companies and also collected some stock options. If some of these companies go public, the bank will receive quite a huge profit from selling their stocks. But most of these stock options were not disclosed in the balance sheet of the company. Sometime later, the management of the company decided to sell their positions in these companies and declared a profit. This immediately affected the stock price. The market understood that it had underlying assets and the company was actually worth more than it was traded. Now you can say that, okay, it is a great concept, but does this margin of safety save me from the inflation, or can it help me to diversify my portfolio? The answer is yes. If we speak about the inflation, from my point of view, there should be a combination of factors like understanding the business model, the competitive advantage of the business. It should be profitable and it should benefit from the inflation, buying this particular company at a margin of safety. The great example is Brookfield Management, which owns, buys, and operates complicated infrastructure projects and real estate objects. Some of them are close to monopoly businesses, so they are inflation adjusted. If the inflation goes up, the company can just raise the prices and declare the profit. This concept can be applied not only in the real estate, but also in the production. Another great example are some of the Turkish companies which export juices to European Union. Most of them have revenues in euros, while their fixed costs are in Turkish lira. And recently, as you probably heard, this currency was deeply affected by the current economic situation and current political situation. So for these companies, it is actually better to have higher inflation because they decrease their costs and they have higher margins. Speaking about diversification, margin of safety can also be implied here. The great example was pointed in the book The Intelligent Investor by Benjamin Graham. Suppose you would have 37 different options to place your bet on the roulette from 0 to 36. Your bet is $1, and if it wins, you will receive $35. This means that you have one of 37 chance to win $35. And even if you place the bets on every number, which equals to 37, you will still lose $2 on your win, 35 minus 37. But if there is a different situation with the price, for example, you will receive $40 for your win. The situation would be quite different because you simply can place bets on every number, which equals to 37, and you would win $3 every time one of your bets wins. In this case, your risks are limited. So speaking about the first case, the more bets you place, the higher your chances to lose money. And if you place 100% of your portfolio, you will lose money. And in the second case, the higher bets you have, the higher your chances to win the jackpot. And even if you place 100% of your portfolio, you will still win. The same rule can be applied in the stock investing. We simply need several bets in our portfolio, and these bets should exceed our risks. I personally consider margin of safety rule is the most important in my investment checklist and in my analysis, because I had situations in my past when I lose money in my investments and businesses by not simply applying this rule. And now this is my number one priority. That's all for today, guys. I hope you enjoyed the video. If do, please leave a like and subscribe to the channel. If you have any questions or any ideas about my future videos, please write down them in the comments below. I will definitely look through and respond on them. Thank you for watching. Bye.